Hello everyone, welcome back to Investing Sucks. My name is Eric and thank you so much for tuning into the channel. So a while back I did a video asking you guys what company you want to see me cover in a future video. And I had a lot of people mention this company here, Docebo. So today we're going to take an in-depth look at this company, look at everything from a quantitative and a qualitative perspective. This is a channel that is dedicated to understanding the fundamentals of businesses. We like to look at companies for what they truly are, the revenue, the cash flow, the earnings behind each company, but we also like to look at companies from a qualitative perspective. We look to understand the context of them. If they do have very strong growth potential, we want to understand that. And we want to just understand everything about them so we can make an informed decision and determine if they are right for our portfolios or not. So today we're going to be taking a deep dive into Docebo. We'll talk about who they are, what they do, the industry they operate in. We'll take a look at historical financial data, and then we'll conclude the video as always by doing a valuation. So if you like this type of content, then please consider subscribing to the channel. I make these types of videos pretty much on a weekly basis now. So if you're interested in learning about business and understanding fundamentals, then definitely consider sticking around. Okay, so the first thing we're going to look at is some valuation metrics on Morningstar, just to kind of understand how expensive this company is and how much future growth is built into this company's current valuation. Okay, so here we are on Morningstar. This is the valuation data here, and really we're left with a whole lot of nothing. I mean, there's not a whole lot to go off of here. This is a fairly new company. I believe they IPO'd in early 2020. No PE ratio, so that tells us that they're not currently profitable. Price to cash flow is very high, so maybe they just became cash flow positive. But if we look up here, we can see the price to sales ratio of 33.2. So that is quite high. I mean, this is, as we know, a software company. Software companies do tend to have higher price to sales, but at a price to sales in the 30s, you're really projecting a company to grow extremely fast into the future. So that's definitely going to be something we have to take into account when we look at historical financial data and we kind of understand the company's context and the growth of the industry that they're operating in. Okay, so who is Docebo and what do they actually do? Well, who they are is they're a cloud-based software as a service learning management platform for companies specifically that helps companies really just disseminate knowledge across their organization, and it allows companies to upload content for other companies to access so they can learn about new products and services, various skills really. So the whole point is to facilitate company-wide learning. So let's say you have a company that they just went on a huge hiring spree, right? They're a growing company, they need to hire a bunch of new employees. Now the company doesn't have the resources to train all those employees individually on specific things. So what they can do is use a platform like Docebo to create, say, an onboarding module or like a learning module for other new employees to do when they get hired and start working there. That way it's much easier for them because they don't have to train all the employees individually. They can focus more on running their business, and it just helps automate the whole process, and it really makes lives easier for their customers. So that's just one example. They offer many services. You can go look at their annual information form if you want to read about them. They currently have about 4 different ones. They actually also have a virtual AI assistant, which kind of helps them, when they're creating this type of content, which is pretty interesting. And artificial intelligence is a big part of their business model. They're really trying to use that a lot to also provide content recommendations for the use of their platform, similar to like what you see on YouTube with the YouTube algorithm. And you can kind of view them pretty similar to YouTube, except for companies specifically, and specifically for learning and spreading knowledge across the organization or sharing content for other companies to access. And in terms of their revenue is structured so that the vast majority of it is annual recurring revenue. Usually they'll lock their clients into more longer term contracts. I believe it was about 3 years was pretty typical for them. And they do actually charge quite a lot to these companies. It's in the range of $30,000 on a per customer basis. So let's take a look at their revenue breakdown, their annual report, to get a bit more information on this. Okay, so I just went to their annual information form on this part here called Description of the Business, and it gives a good overview of this. So it says here, our solutions are sold on a subscription model, pretty typical with software as a service, right? You have that subscription basis, annual recurring revenue, all very important metrics for them. Structured with an initial fixed term between 1 and 3 years. So a bit more longer term, I mean not super long term where it's like 5-10 years, but it's not just one-off fees, it's annual recurring, which is a great thing to see. And then we can see we charge our customers based on a per learner fee, per module basis, varying depending on the size of the organization, complexity. And then it says here, so fiscal 2020, 90%, and 91.3 for fiscal 2020, 90% for 2019. Came from annual recurring revenue from their subscription-based plan. So the remainder of that revenue would most likely be professional services revenue, which is really just support they provide to their clients when they're initially onboarding them, just because they need to learn a bit more about how to use the software, how to get their employees and train them on it. So majority is going to be made up of that part here. And it's interesting that it's on a per learner basis, because that means the companies they sell to, if the company grows, they're going to need more people to get onto the Docebo platform. So really they have a stake in the success of the customers they're selling to, because if the amount of learners that they want to have on increases, then most likely the fees that they earn will increase, which is a great thing to see for a company. Okay, so now I went to their 2021 second quarter management discussion analysis section, and this gives us an overview of their revenue and kind of what their cost to revenue is. We want to look at this because we want to see, well, for one, how fast are they growing, and also what their margins are, because as we saw with a company that has a price to sales ratio in the 30s, you better see very high gross margins, and that's exactly what we see here. So their cost of revenue was just over that's 5 million there, because these are in thousands. And then their quarterly revenue for the second quarter of 2021 just surpassed 25 million. So that'd be over 100 million on an annual basis. So that's over an 80% gross margin. That's a huge gross margin, and that's great to see. That's why we love software businesses, specifically software as a service. Now, we can tell, obviously, as we looked at before, they're not currently profitable, but a big reason for that is their sales and marketing. That's their biggest expense down here, $10.5 million. So that's probably what they're investing in order to grow the business, get word out there about their products and the value they provide. Okay, now let's talk about why this company is valued as high as it is. Why is this company trading at a 33 price to sales multiple? What kind of growth catalysts do investors see in this industry? Well, for one, there is the remote working trend. Now, if you guys have been watching my channel for a while, you know that I do think that this remote working trend has been a little bit over-exaggerated. I think people in general are overestimating the extent to which workers in the future will become remote, just because I think there is a lot of value to actually having employees go into a physical office and interact with each other, which I don't think that should be something that's overlooked into the future. However, I don't deny the fact that in the future there will be a lot more remote workers than there are currently today. I think that's a pretty safe thing to say, and I don't think many people will contest that point. So a company like Docebo would benefit from that trend, because when companies are onboarding employees and those employees are working remotely, it's a lot easier to give them, just say, a learning module to onboard them, or just beyond, onboarding employees, just having employees in general, and you want to disseminate knowledge. For example, let's say it's some process that they just implemented in their company that they now want their employees to follow. It's a lot easier to use a platform like Docebo, where you can kind of just create a video, put it up on the platform, and then all the employees can access it. They can go back to and refer back to it if they need to. And also, if you just want your workforce to develop more skills, let's say you want your employees to have better presentation skills or better IT skills, better customer service skills, all those types of things. And if you're working remotely, it's going to be a bit harder to have physical in-person training sessions. So the way you're going to do that is you're going to use a platform like Docebo. So I do think that that's one main growth catalyst that investors are expecting to see within this company. And also I can kind of foresee a bit of a network effect happening potentially as this company grows into the future, if they are able to achieve the growth that many of the investors are expecting to have. Because say if a lot of companies create content, put it exclusively on the Docebo platform, in order to access certain content, companies are going to have to sign up for the platform, and the more companies that sign up, the more valuable the platform as a whole becomes. So that is something that I could see develop in the future that would maybe give them an economic moat. I mean, I don't want to speak too soon on that because it is pretty early to tell. This is a very young company, and they do have to achieve a lot before you can definitively say, yes, they have a moat. But I think it's something to keep an eye on going forward. Now, in terms of actual numbers, we want to see, all these qualitative factors we just talked about, we want to see them manifest in the actual company. So you want to see actual strong growth rates, number one in revenue, but also in revenue per customer. You want to see high retention rates. So let's actually go into their filings and see if we can find evidence of that. Okay, so here I went to their management discussion analysis filing for their second quarter of 2020. So this is as of June 30th, 2021, and it looks at kind of year-over-year data. So we can look at subscription revenue and then professional services and look at the growth rates there to understand revenue growth from a high level. So clearly it's gone up quite a lot. We have a very strong change there, 76%. It was in this same quarter in 2020, 13 million, and now it is just under 23.6 million if we're looking at subscription revenue, which is really what you want to look at. That's where the company's going to make most of their money. And then if we look down here, they actually explain why this happened. So the significant revenue increase in the current period was primarily attributable to revenue from new customers. So that's a good thought. That's a good sign. They're having more customers sign up for their platform, as well as upselling to existing customers. And then we can see here as the number of customers rose from 1,923 to 2,485. So that's not a huge amount of customers, but it is kind of proving that the value per customer is quite strong. So they're actually, earning a lot of revenue from each individual customer. And then it continues here. So the average contract value per customer increased from approximately, it says $30, but really this is in thousands, so that should be 30,000 as at June 30th, 2020 to approximately 38,000 as of June 30th, 2021. So we can use those numbers we just looked at to help us calculate what's called net dollar retention rate. This is an extremely important metric for when you're analyzing software as a service companies. Now, if a company has a net dollar retention rate of 100%, that means the amount of revenue they're earning per customer in the current year is exactly the same as it was in the last year. So you want to see it to be above 100%, which means they're upselling their current customer base and earning more revenue per customer, which is exactly what we saw here. I mean, it was $30,000 as of June 30th, 2020, and then it went up to $38,000 per customer. So that means they're doing a great job of upselling their current customers, and it really shows how valuable the platform they provide is if customers are willing to add more services to what they want Docebo to provide to them. And overall, that's going to be a great catalyst to lead to increased revenue growth into the future. Okay, so all those things we just talked about are obviously great signs. They're great data points to see in a company and are definitely indicators of a bright future of this company. But keep in mind, they're currently valued at $2.9 billion in USD when they haven't even hit 100 million in annual sales, also in USD. They report their numbers in USD. Now, obviously, they are probably going to reach that in the future. They'll probably hit 100 million or surpass 100 million in annual sales in the current year. But let's now look at historical financial data. There isn't a whole lot of historical financial data for this company, again, just because they IPO'd rather recently. So what I'm going to do is just look at year-over-year financial statements and just point out a few key things that I think you should understand about this company. But in terms of revenue growth and what it's been historically, pretty much every year they've been growing their revenue at about 50 or 55% on a year-over-year basis. And then compounded annually over the past 4 years, it's been about 40%, something like that. So obviously very strong revenue growth, and it's likely for that to continue going into the future, but maybe it'll slow down a bit just because growing at 50% annually year over year is quite difficult. So all those things will build into the valuation, but first let's just quickly look at some historical financials. Okay, so here I went back to their most recent quarterly filing, and we'll just take a quick look at their financial statements. So we're starting off with the balance sheet. Now, since this is a new software company that recently went public, it's pretty much a given that we'll expect them to have extremely high cash balance relative to all their liabilities and probably most of their assets as well, which is exactly what we can see here. So 216 million in total cash as of their most recently filing, which is June 30th, 2021. Total assets is 257 million, so very significant amount of their assets is really just cash that they have, probably from some of the funds they received from issuing shares when they went public. And we scroll down here, we can see total liabilities, 63 million. So plenty of cash on hand to pay off all their total liabilities. That's a great sign to see for this company, but it's pretty much expected as well. And they don't really have much debt either. I mean, if we look at their non-current liabilities, we don't see any long-term debt. It's pretty basic ones such as lease obligations, employee benefits, deferred taxes, contingent consideration, all those types of things. And then we can look at shareholders' equity. Again, not much out of the ordinary here. There's a bit of a deficit because they've had some accumulated losses, but pretty standard overall. Now, if we look at their income statement, we looked at this kind of already, but we can look at it a bit further to help understand some of the changes. So it looks at the 3 months ended as of June 30th from 2020 to 2021, and then also 6 months from 2020 to 2021. So, very strong revenue growth. Again, their biggest expense is really just their sales and marketing, which is a big reason for that is just because they're trying to grow. They don't have any operating income yet. I think either maybe later this year in a future quarter or next year in one of the earlier quarters of next year, they should be able to turn a profit just based on the revenue growth and how low their cost of revenue is. But really they could become profitable if they just cut back on those sales and marketing expenses. We go down here. Another concern we have with these fast-growing software companies is we don't want them to be issuing too many shares because we don't want to be diluted as a shareholder. Now, the good news is they haven't actually been diluting shareholders that much. This isn't a company that has acquired many other companies. Usually that's one of the bigger reasons why you see these software companies like the amount of shares they have outstanding grow so much is because they just issue a ton of shares in order to make acquisitions and expand their business inorganically. But with this company, it's been pretty much solely organic growth, so you haven't seen a whole lot of dilution. Now there's a bit of dilution if we compare the balance of common shares outstanding, about 28.5 million as of the year end of 2019 compared to what it is currently at 32.7 million. I mean, that's a bit of dilution, but it's not a whole lot, especially considering they went public during that time period. So most of that dilution there is just due to them having gone public and probably issuing a ton of shares, which is why their cash balance is so high. But really, I mean, we can see the only dilution they're really having in their share balance is just a bit of stock options, which maybe they grant to their employees. So dilution isn't much of a concern for this company, which is a great sign to have. Okay, so let's now jump into the valuation of this company. Now, since as we saw before, the company is currently operating at a net loss. They aren't free cash flow positive yet, so we are going to use the EV/EBITDA multiple earnings approach to value this company, and I'm going to use a 5-year time horizon. Now, the whole goal of this is to determine what their shares will be worth 5 years into the future and how much of a return we can expect if we buy their shares today at their current price and hold them for those 5 years. Now, usually we'll adjust our assumptions because our goal is to get a average annual return of at least 15%, which historically would be market beating. That's what we aim for on this channel, because that's really why you would want to invest in an individual company. Take on that additional risk is if you expect it to outperform the general market. Now, this spreadsheet that you see beside me right here, I created this spreadsheet for subscribers of this channel specifically, so you can download it completely free of charge. Just head to the link of the description of this video. You'll see a Google Sheets file, so you can click on that, download it into Excel, and you can use it for your own personal research if you want to. Now, something else that's important to note is when I do these valuations, typically I like to go just based off of what I think is reasonable and slightly more on the conservative side. I don't necessarily go with management's projections or anything like that, just because I don't want to be disappointed if management ends up being wrong and they end up overshooting their projections. I do think they're important to look at, but really I like to be an independent thinker and go based off of what I think is reasonable and what I think is fair for the company. So I'll take you through the valuation now. Okay, so in pink here, I've got my assumptions, and in the yellow here, it actually spits out the valuation. So I'll start by going through the assumptions. So all the numbers are in thousands of USD because they do report their information in USD. Again, I did a 5-year analysis, so going into 2025. The revenue of their most recent year end, which was the year 2020, was just under $63 million. Now, I'm assuming 40% annual revenue growth for the next 5 years. So that actually brings their revenue in 2025 to about just under $340 million. Keep in mind what it's at currently on an annual basis is just over 100 million. So very significant growth there. Now, these enterprise value assumptions is really what's most important. So I'm going with a very high EBITDA multiplier here in the year 2025 of 40. So that is pretty high. Now, someone asked me recently, how do you determine what's a reasonable EV/EBITDA multiple to use? And there's many things that you can look at in order to determine that. So one of the things to look at is if it's a growing industry. And as we previously discussed, there are many catalysts in this industry. Another thing to look at is customer retention rates. So we know those are very high, as we saw with the net dollar retention rate being over 100%. Also, as we saw before, they're adding new customers. So both of those would lead us to want to have a higher EV/EBITDA multiple. Another important thing to look at is what's called operating leverage. So what operating leverage is basically the extent to which the company's cost structure is allocated between variable costs, so kind of like cost of sales, versus fixed costs. So costs that don't change depending on how much sales volume the company will do. Now, as we saw, their variable costs, so their cost per sales, was extremely low. So having high operating leverage means if they are able to increase their sales as what seems likely, they're going to be worth a lot more in the future. And as a result of that, you're going to want to have a higher EV/EBITDA multiple. So that explains why I'm using 40 here. It is quite high. Now, the EBITDA margin, so the percentage of their revenue that they convert into earnings before interest, taxes, depreciation, amortization, I went in the 25%, which is about ballpark of what you can expect for software as a service companies that have gross margins in the range of 80%. Now, maybe their EBITDA margin will be a bit higher than that, but let's just put that 25%. If it is higher than that, that's just additional upside that we can get into this valuation. Now, I've also assumed no debt. We saw that they had essentially zero debt. Now, maybe they will take out some debt in the future, but that's pretty tough to predict. I think they will stay financed mainly through equity, so I'm assuming no debt. Total cash in 2025, I assumed it's going to be slightly higher than what it is, so 350 million. These two assumptions here aren't that important. It's really more about, these assumptions here that make up the bulk of the valuation. Now, current shares outstanding, this was as of 2020, was just under 29 million. Now, as we saw, it's about 32 million, and there wasn't a whole lot of dilution. So I'm only assuming 3% growth. So really not that much dilution beyond what they currently have. And then their current share price, this is in USD by the way, just under $89, so 88.65. So let's look over here and see what kind of return that spits out. Okay, so based on all those assumptions we just put in, again, they're reaching 338 million in revenue by 2025. Again, some people may think that's too conservative, some people may think that's too aggressive. Here's our enterprise value. We get our market cap there, divide by shares outstanding, so our price per share estimate in 2025 is about $111, again in USD. So that only gives us an average annual return of just under 5%. So that's really not what we're looking at. So let's adjust our assumptions and to see what it takes for this company in order to get an average annual return in the 15% range, because that's what we want, that's what we think is reasonable. So let's assume the revenue growth goes even higher. Let's say it's 50% a year. Again, I'm not saying that this is definitively what I think. I'm just simply putting in numbers, doing the math to show you guys, so you have the information needed to make determinations for yourself. So at 50% in 2025, the revenue is almost 500 million, $478 million. So quite a lot. Their share price in 2025 here, over 152, so $153 per share, again in USD, and that gives us an annual return of 11.5%. So that's a bit better, but again, we're going for 15%. So let's adjust things even more. Let's say their EBITDA margin is instead 30%, so it's higher than what we think. Okay, now we're more in the range of what we want. So we can see here we're getting just over 15%. So if you think that those assumptions that I put in are reasonable and they make sense, and you're okay with accepting this return, then it does make sense to buy into this company at its current valuation, maybe research them a bit more and determine if they're right for your portfolio. But again, the question you have to ask yourself is this reasonable? Because these are strong assumptions, right? Like this 50% annual revenue growth rate, that is a strong assumption. And yes, that has been what it has been historically, but if we look at what the destination of that is, I mean, it's almost 500 million in 2025. Could they achieve that? Sure. But is it likely is what you need to ask yourself. And then again, with all these other assumptions, just are these reasonable? Do these make sense to you? That's just what you have to determine for yourself. Okay, so let's go back to the main question of this video. Do I think this company is overvalued? Now, I don't think this company is necessarily overvalued. I do think that their valuation obviously is very growth dependent, and the company is going to have to grow very fast in the future in order for it to justify buying into their stock at its current price. But I do think it's definitely feasible. And if you truly believe in this company, you believe in the destination and what it is they're trying to do, then there's definitely still some room to get in. But anyways, guys, that pretty much does it for this video. So thank you so much for listening to my thoughts. I hope you did enjoy this video and you found it useful. Again, please consider subscribing if you're new to the channel and like the video if you did enjoy it. And I'll see you in the next video.